But at minimum, I think you could see $200 silver in the next 6 months or so. Sounds lunatic? No. And it wouldn't shock me to see silver at some point in the next couple years during this, what I think is an oncoming crisis, to be $1,000 an ounce. Suddenly are perceived to be, holy cow, I'm buying this little junior miner. What I'm really doing is buying bullion at 10 cents on the dollar.
Gold versus the S&P 500. Gold has broken out only now. Let's elaborate on that, Michael.
Yeah, well, what you're looking at is a spread chart, meaning I divide an ounce of gold. I use the front month active COMEX future. Right now, that'd be the February 26 contract. December is in delivery, so we rotate to the Feb. So the February gold contract, which right now is 42.40, I think, as we speak. But last month, these are monthly closes you're looking at here, are plotted. What's the price of gold expressed as a percent of the price of the S&P? And you just simply plot those charts every month. Here we go back to 2013, and that was the year in which gold, after the 2011 high, really started to implode in 2013. And naturally, its relative performance to the S&P, this spread chart, was in collapse mode as well. Okay. And by the time you got to late 2015, that spread dropped down to about 50%. That's on the left side of that chart there, with the first low just above 50. And gold at that point, if you draw a line sideways from late 2015 on the spread chart, you'll notice it's been above and below that level, zigzagging for 10 years. So almost you could say gold's been par to the S&P in terms of performance. Sometimes better, sometimes worse, but net on balance, at that, let's say that low in 2015 at about 51%. It's been either side of it. So you could have flipped the coin back in 2015 and bought gold or bought the S&P. And for most of those years, you'd be making money or losing money or making money, nothing in other words, okay? Right now, what's happened is that close in November took out a 1, 2, 3, 4-point trend line, almost flat, across every single rally high in that spread, going back to 2014 rally, in late 2014, its first peak. That is a beautiful trend line. If this were a price chart of ABC stock, and you broke out over that line, and you were looking at the price chart, what would you say? Oh, we have a breakout. I got to buy that thing, okay? This is a fresh breakout. What it's saying is, yeah, we've seen strength in gold since early, 2024, actually. You can see it spread went from 40% up to 60. But it's only just now broken out. So this game is really just beginning. The movement of money into gold, monetary metals, and out of the stock market. Important chart.
This is the signal smart money has been waiting for. Gold isn't just rising in price. It is finally outperforming the S&P 500 after a decade of stagnation. To stay updated on these critical market shifts, make sure to hit that subscribe button right now. Now, let's see just how high this can go.
Very, very important, absolutely, because it sort of signals a little bit what the banks have been trying to tell us here as well. It's just building on that, the 60-20-20. I'm very sure you've heard about that as well.
Yeah, I heard that. Yeah. They should have reversed it, though. It should have been 60% gold, 20-20. Okay, but anyway.
I was going to say, let's not get too greedy here, but that's part of the momentum game, isn't it? Like, is that something you're tracking or looking at, like influencing momentum? Is that picking up now?
We run momentum studies of these charts too. In fact, later on, we'll look at one regarding silver. But the point is that when you get this kind of breakout, and its momentum has also done the same thing, except earlier, it's saying something big. It's saying this is a monstrous base of monetary metals holding their ground versus the paper bubble. Everybody's cheering the stock market for the last 10 years, but nobody's noticing that you could have flipped the coin every 6 months and either been ahead or behind in gold relative to the stock market, but basically net sideways, meaning as well as the S&P. Nobody notices that. And I love that because they notice it later, But anyway, this is a breakout and it indicates something. You're not going up for 2-3 months here. This is going up for a couple of years. And God knows where it's going. But this is a massive base that will have a massive move, and it just began. So people who look at a gold chart and say, oh my gosh, that's so steep, it's gained so much ground, they need to step back a bit. And another thing about gold if you go back for the last 50 years since it was legalized in the U.S., you had two bull markets that were eightfold, bear low to bull high. It was 1976 bear low to 1980 high, 2001 to 2011. Both were eightfold dimension gains from low to high. We're only fourfold. Our low was 1,050. We're 4,200. You go about mid 8,000 area and you can say, oh, I've at least matched the two prior bull markets in terms of dimensionality. So even on that metric, gold is hardly overdone.
No, it's it's scary because if you look at that just the gold price chart, you say, okay, like you said, well, 4,200, this is like ridiculous. Like it's a proper hockey stick, but in relation to what else, to the other like asset classes, like the S&P 500, we still have catching up to do. Absolutely. And that chart really shows it. And maybe just to sort of maybe summarize what you just said as well, like, do you have any inkling of where this could be going? You said we're up 4x since the bottom. Like, is there a ceiling?
It's at least match the old highs, and everybody will think it's overdone there. They think it's overdone the whole way up, and I love that because that keeps it going. If everybody's on board, and we know that the Western world, especially the U.S., is not on board, the average investor. When they finally get in, it's going to be a wet bar of soap type phenomenon, especially silver. My own personal conviction, my personal positions in markets heavily emphasize monetary metals, but especially silver. Now, on this page, we show the gold miners going back to 2013 versus S&P. They've also broken out. Then the bottom chart there is silver price divided into S&P going back to 2013. You also had a downtrend. You broke out above it too. So all the monetary metals and their miners just broke out over an 11-year wide performance base. It's just begun. It's not just gold, it's the miners as well. It's silver. Monetary metals and their miners have shifted into bull phase versus paper bubble.
Did you catch that? It's not just gold anymore. The entire sector has shifted. But here is the key. Silver is about to take the lead. And historically, when silver leads, the gains become explosive.
And the next page is the most illuminating of all, if you want to do that one.
Absolutely.
Okay, the top chart is back to 2020. Silver versus gold. You divide an ounce of silver into an ounce of gold, express it as a percent. And back then we were under 1% in early 2020. And it exploded to 1.5% in a matter of a year. That was during that 2020 surge in the monetary metals. Gold went up 40%, silver doubled. So the spread increased. After that, silver, though going up in price mostly, had an erosional backing off on the performance. And it developed a downtrend and also a green horizontal ceiling. It blew through both last month. It's fully broken out of a massive base that goes back to 2021 on that green line, which is the most important one. So not only are the monetary metals now going to beat the S&P, but within the monetary metals, silver is going to lead gold, is our argument. And I have certain expectations of silver that are rough, but at minimum, I think you could see $200 silver in the next 6 months or so. Sounds lunatic? No. There's many other historical comparisons where other markets have done comparable events with far less fundamental driving factors than silver has right now. And it wouldn't shock me to see silver at some point in the next couple of years during this, what I think is an oncoming crisis, to be $1,000 an ounce. God knows where gold might be at that time. It might be highly likely to be institutionalized as a money unit again. This country, that country. A growing contagion of people saying, hey, this fiat stuff hasn't worked. We've been playing with it for 100 years and it's just created boom busts. Let's go to real money. It takes pain to cause that kind of rethink, but I think that's what we're about to step into.
Like on a gold-silver ratio scale then, like maybe we're at 73 right now, and we're coming from 104 down to 73. If you were $250 silver, let's go with a conservative price target here, Michael. I
don't look at it that the ratio scale. Yeah. I do it with the percent, but let me talk about this chart here. if you take this one back 50 years, everybody looks at the ratio scale. Fine, it's fine. It's just an upside down version of this. The bull market in 79.80 took silver to 6.5% of the price of gold. Okay. The bull market in 2010-11, when silver hit $50 again, was at 3.5%. Right now, this chart is not up to date. Right now, we're pushing up toward 1.4%. But even 1.4 to go up to 3.5, which it was during the last bull market, is a huge gain. It's almost tripling in the relative value of silver to gold. God forbid you go to the 1980 peak reading, which would have 6.5% the price of gold. And silver's not going up, by the way, and gold's sitting still. So as we're measuring silver relative to gold, we're measuring silver versus another rising market as well. So it's kind of hard to tell. We think this spread is likely to go in this surge up to at least 3%, meaning silver should at least double and a half. And once the spread breaks out, by the way, which it has just now, silver gold, you go back to 79, you'll see a similar incident in the summer of 79. 5 months later, silver had quadrupled to almost quintupled in 5 months. 2010 to 11, the last 7 months of that bull trend, silver doubled in a half in 7 months in net price. Think about it, and then realize
now we have social media. So the trend is going to, like, the time frame is going to be
much
shorter.
Bigger crisis. We have a much bigger crisis.
Yeah,
silver's headed for a new reality. That's what's happening.
Yeah.
This is a massive prediction. He believes silver could hit $100 or even $1,000 because of the social media multiplier. In today's world, information moves instantly, meaning price spikes happen faster and harder than ever before.
Now, it's interesting, maybe to summarize a little bit, what you're saying is like gold should double from here, meaning, let's say from...
Absolute minimum. I don't know where, that's a joke target, because it's laughable because we've done it twice before. So it's not even exceptional. Okay, there, you go ahead.
But you're on, like, my point is, though, I just really want to highlight, like, the torque silver has now and the momentum that is behind silver, and the price, the opportunity for us investors behind silver, of course, is much greater perhaps than in gold. And I'm just trying to highlight that a little bit. The other question, of course, is, Michael, how do we play this as investors? And again, not a financial advice or anything, but what's a smart way? Long dated option contracts? Do we just buy and hold?
This is my position. Everybody's different because everybody has either more money, less money, more time sensitive, less time sensitive, doesn't want to do leverage, etc. I'm entirely in silver portion of the monetary metals. I own calls on SLV. AGQ is a double ETF of silver. I own that. I own the top 4 biggest silver miners. I also have long-term or leap calls on the top 4 big silver miners. I own about 7 or 8 junior miners, and I'm likely to increase that. I think in particular, as silver explodes, the silver miners will go absolutely berserk. They are vastly undervalued to gold miners. And you'll see on the bottom chart there, that's SIL versus GDX. That's the silver miner ETF versus GDX, which does contain, by the way, some silver miners. Look at that spread. It's crowding for the last 4 months, that green line. And right now, I think you're marginally above it. This is as of last month's close. So when that breaks out, the silver miners versus the gold miners, that's when you're going to see an echo effect of what silver's doing versus gold, breaking out. In which case, the best place to be among the miners should probably be some emphasis on the silver miners. I think they have much more potential percentage gain, and it could be very dramatic. I don't just mean doubling, if you know what I mean. I mean dramatic. And it's a tiny little sector. As the money flows into it, it skirts it up.
It is a tiny sector, Michael. Like, it's really difficult to find pure play silver companies anyway. I think there's 3 at best.
Well, there's a lot of juniors.
That, right?
Yeah, there's a lot of juniors, and fortunately for silver, the fundamental is that most silver doesn't come from silver mines. It comes from base metal miners who produce silver on the side as a marginal product. Hence, their primary motivation or profit-driven factor is the price of copper or the price of some other base metal. Not the price of silver. It doesn't motivate them to mine more copper to get the little bit of silver they get out. So the silver miners are highly focused little beasts that even if they're tiny little guys, and maybe the cost of production at 30 bucks an ounce was not really good for them. Now suddenly we're pushing towards 60. What if suddenly you're 150? Suddenly these once seemingly worthless little mines, which have the real thing under the ground, think about it that way, they got the bullion under the ground, suddenly are perceived to be, holy cow, I'm buying this little junior miner. What I'm really doing is buying bullion at 10 cents on the dollar.
That is the ultimate value proposition. Buying junior miners right now is essentially buying gold at a 90% discount before it comes out of the ground. It's high risk, but the reward potential is generational.
Okay, so that's why my emphasis is there.